Ladies and gentlemen, good afternoon. In the first session, we have talked about the nature of Islamic finance. We have tried to, at least to demystify Islamic finance, and we have tried to show how an Islamic bank can still finance companies outside the realm of interest, which is not something that appears to be obvious. In the second session, what we will attempt to do is basically to review the products that we have touched upon at the end of the first presentation, but from a practical perspective, that is from the perspective of how a deal is actually undertaken by a bank. Again, you know, as I mentioned earlier, the most commonly used product is the murabaha. And we will see now how a murabaha transaction is actually practiced by a bank for the purpose of providing financing to its customer. This is a slide that you are probably familiar with because it is the same slide as I had put earlier. We defined murabaha as being an unconditional contract of sale between buyer and seller, where the goods, cost price, markup, and payment date are all clearly defined and agreed. The payment is deferred with a price higher than spot. The goods and the nature of the goods. Now, here again, the slide on the structure of the deal. We have the seller who agrees with the buyer. Of course, the type of the goods, the terms and conditions for the payment, and the delivery. And then once that is agreed, then the payment is made. Once that is agreed and the goods are delivered at a certain date in the future, the settlement price for these goods is made, and that's item number 3. Now, these are the steps that are taken for the purpose of a murabaha. Buyer signs an agreement unilaterally promising to purchase goods from a bank. That is actually a real transaction. Buyer is appointed by the bank as its agent, and once it is appointed as its agent, goes ahead and under the agency orders the goods that are theoretically required by the bank. Once these goods are acquired by the client on behalf of the bank, the bank sells those goods back to sells those goods to the client under murabaha contract for an agreed markup and for a deferred payment, which is for a tenor, for the payment to be made in the future at a tenor which has been agreed and which is the required financing time. The debt created, of course, has to remain on the books of the bank, because in Islamic banking, trading in debt is something which is not allowed. Again, trading in debt means really recognizing time value money and therefore discounting it. Under Islamic finance, it cannot be done. Here we have the structure. We have a purchase and sale agreement, which is signed between the bank and the buyer. We have, at the same time, once the purchase and sale agreement is signed or is executed, we have an agency agreement where the bank appoints its client as its agent to purchase the goods that the client really wants for and on behalf of the bank. Now, of course, if the bank would like in any conventional bank, to have security, for the settlement price in the future date, the bank can ask for, as a conventional bank, for any security that it wants, whether it's a mortgage, whether it's a guarantee from another party. These are things that are practiced, and there is nothing wrong with them in Islamic finance. No. So that was the murabaha. The murabaha then is about the bank purchasing through its client the commodity or the goods that its client wants to purchase for a spot payment. Once the goods are delivered to the client, then the bank will claim its sale price in the future as agreed with its client. Now, the second product which we have discussed, or which I have briefly touched upon, is the Salam product. The Salam product is about providing cash in advance, to a client who needs to purchase commodities for trading purposes. It's basically pre-financing of commodity, say, sales or exports. So we have the bank, in order to provide this type of financing, actually prepays the client for the commodity that he wants to buy, and agrees with him on a certain date in the future for the delivery of this particular commodity. Of course, the specifications as regards the commodity, its type, as far as the price is concerned, as far as the delivery date and delivery place, all of these have to be agreed in advance. But we have a situation where, yes, the bank has provided finance, yes, the commodity trader, say, has been enabled financially to purchase the goods, but the bank wants to make sure that it does not end up with a commodity at the end of at the agreed future date. It wants to make sure that it can turn that commodity into cash. So generally speaking, the bank at the same time appoints its client, as being its agent to sell the commodity that it would have acquired at the date that has been agreed in the future to a third party, so that the bank can get its cash back with a profit. Now, generally speaking, of course, the profit is calculated to be equal to what a conventional bank would charge in terms of interest, because let's not forget that Islamic banks are in the market competing head-on with conventional banks, and the profit margins that Islamic banks charge have to be similar to those of conventional banks, provided, of course, the risk that we are talking about is similar. So the structure of the deal goes as follows. We have, again, the buyer and the seller. Prior to the banking transactions, we have a buyer agrees payment terms and specifications, orders, and prepays the seller. And the seller is supposed, at a certain date in the future, as agreed, supposed to deliver the goods. So a Salam contract consists of prepaying a trader for goods to be delivered in the future, and then to be on-sold to a third party. The sale to a third party can be, a regular LC that the client asks his customer to open with that particular bank, or it can be another salam contract, what we call a parallel salam contract, that is an identical structure, but on the other side, or by simply appointing the trader as an agent to sell the goods that have been purchased to a third party at a higher price. The mechanics of the deal are basically, as we have seen, the first part was for the purchase. The second part is you have the buyer, we have the trader who actually purchased the commodity and delivers the commodity on behalf of the bank. And when I say on behalf of the bank, when acting as an agent to the bank, the buyer pays the trader for and this is at the future payment date, pays the trader, who in turn uses the proceeds to pay the bank. Now, if we look at, if we analyze a little bit more a salam contract, we notice that the company, which is the borrower, in fact, obtains the financing that it requires from the bank, but not in the form of a debt. It obtains it in the form of a prepayment for goods or for a commodity to be delivered in the future. Now, this prepayment is not considered as debt. And if it's not considered as debt, it has theoretically no impact on the debt-to-equity ratio, which can be an advantageous aspect or can be an advantageous way of attracting funding. Also, because the actual sale is done on behalf of the bank to a third party, the risk of the receivable would have been eliminated under a salam contract. Profit is cashed in advance, and again, I mean, possibly the cost of capital is reduced. Istisna, as we saw earlier, is a product which is similar to salam, but it relates to providing finance for the working capital cycle of a manufacturer, whereby the bank orders goods to be manufactured by its client, and the obligation of the client is to provide those goods once their manufacturing is done at a certain date in the future. So that is what the obligation of the company is: produce and deliver these goods to the bank. Again, like in the salam, the bank is not interested in taking delivery of goods. What it is interested in is in having back its having the goods to be delivered, sold on to a third party at a profit, so it can basically recognize the deal as being a financial deal where it has made a profit, or a commercial deal where it has made the profit. So generally speaking, again, under this structure, the offtake is from the client of the borrower, and can be in the form of a letter of credit which is already opened in favor of the client at the counters of the bank providing the finance, or it can be in the form of an offtake simply in the form of a risk which is acceptable, the buyer whose risk is acceptable to the bank, whether it is with the letter of credit or without a letter of credit. is something that is a risk that the bank needs to analyze and accept or refuse. The structure is very much the same as that of a salam sale. We have agreements between the purchaser and the bank, where there is agreement on the payment and on the specification of the goods. An order is made, and payment can be made entirely in advance, can be made on a progress basis, or can be made towards the end. It depends on the contract. Then the manufacturer delivers goods to the purchaser. Here is with the involvement of the bank, we have the purchaser and the manufacturer who enters into a contract. Then in order to obtain finance, the manufacturer enters into a similar contract with the bank, where the bank would pay him in advance, which will allow him the working capital required to manufacture. And once the goods are ready, they are delivered to the original purchaser, who then basically pays the manufacturer, who will use the proceeds to settle basically the bank for the goods that they would have purchased from him, that he would have sold to them, sorry. Now, an istisna contract has several uses, can be used in several examples, and these can be, an istisna can be used for property construction. It can be used for ship or aircraft construction. It can be used in oil or manufacturing equipment installation, bridge, highway, anything that really requires construction, requires manufacturing, can be, an istisna can be used to finance them. Like it is the case in a salam contract, an istisna contract consisting of a prepayment for a manufactured good to be delivered in the future means that there is no leverage, means that there is no debt to be recorded as such by the company which is obtaining the financing, and therefore it is balance sheet friendly. It is not a product which will use up capital. Thank you very much, sir. Also, and at least this is true in certain jurisdiction, because what would be considered as interest under a normal financing form is a trading profit under istisna or under salam. This form of financing, and at least we have structured it in Southeast Asia and in particular in Thailand, and we have noticed that it saves the client withholding tax on interest payment, and that overall reduces the cost of financing to the borrower. Ijara, I will not dwell on this because we have gone over it in the previous previous presentation, and we've highlighted the main differences between say a conventional and an Islamic ijara, and these differences are mainly relate mainly to insurance, to maintenance, and to the payment of rental during the lease period at times when the asset can no longer be used for whatever reason. What I would like, however, to attract your attention to the expert. Oops. Any expert?
That's not good. Yeah.
And even without the slide, I mean, typically, as I mentioned earlier, when when a bank wants to basically look at the requirements of its client, generally speaking, it is within the context of a particular transaction where we need more than products. For example, in the project finance, what we will have recourse to, an istisna, a transaction with the client, and then for the repayment, we will have a hire purchase, which is a finance lease. And of course, the structuring of the istisna, which is followed by a finance lease agreement, will have all the elements that normally we would, or all the steps that we would normally see in a conventional transaction in terms of setting up special purpose vehicles and okay, we're back. Thank you. Anyway. Fine, that's okay. That's okay. Wow. Again, Islamic finance is about financial engineering, and the reason why we say financial engineering is that because we try really to combine basically economic, or say economic activities with financial activities, and combining both results in these structures that we have seen. And these structures can be much more sophisticated, much more complicated in transactions such as typically a project finance transaction. Here we're talking about, for example, a project finance transaction that involves an LPG project. We have Islamic banks in the form, say, of a syndication, which are led by a lead manager, forming a special purpose vehicle, which agrees an istisna for the erection of the LPG plant, and once the LPG plant, for the repayment, they structure a lease, a finance lease, a hire purchase, which end up with the plant belonging to the party that has ordered in the first place. Now, the combination of an istisna and a forward lease is called an ijara mawsufa bil dhamma, which is a future lease which is with pre-specifications. So here we have an SPV which orders the construction of the plant equivalent in value to the Islamic tranche. And here, to make the deal even a little bit more complicated, we assume that the financing is a co-financing between a group of conventional banks and a group of Islamic banks. So if we take the Islamic tranche, we will see that the Islamic tranche will take care of part of the plant and will basically handle its part on an Islamic basis, leaving the conventional side do its part on a conventional basis, but taking into consideration a number of issues, including issues that relate to security, okay, and how to share security given the fact that Islamic banks want to own the assets. So we have again the SPV which orders the construction of the plant. The SPV makes staged payments for equipment purchase and construction, payment of profit element only during the construction period and the forward lease. And then the SPV becomes, at the end of the transaction, becomes the owner of the plant and leases the plant for, say, a tenor of 5 years, which is the pre-agreed tenor, to the operator who is the client. Operates the compressor plant and makes rent payment. The constructor, once the lease payments are completed, of course, title passes on to the client. Okay. Okay. Thank you very much. I would like to leave any questions that you have to the sessions afterwards. Thank you. Thank you very much.